Welcome to Markets in a Minute. My name is Austin Duke. I'm financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, October 13th, 2025 edition. Let's get started. All right, we'll start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will go up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. I think 2 weeks ago we said that we would expect the market to go up for the last couple of days in September and then potentially go down once we got into October. The market did go up at the end of September, and we actually started off October not too bad, and we were poised to end the 2 week period with a gain, and then Friday happened. From what I understand, there is still trade tensions between the US and China. So on Wednesday, US time, or Thursday in China, there were some export controls that China announced that would take effect on November 1st. President Trump and China are supposed to meet on November 1st to hammer out some more of the trade negotiations that have been ongoing this year. And this announcement from China was, I guess, unexpected, largely from an investment perspective. But essentially, what they're looking to do, China controls about 70% of the global supply of rare earth materials that the US will import and use for semiconductors, artificial intelligence type technology, as well as defense manufacturers. And it wasn't just that they were going to be putting on these controls and requiring more licensing for these US companies to import these materials, but the rumor was China was going to be denying the applications and not allowing the US companies to import these materials. So President Trump, at about 11 Eastern, 9 a.m. my time here in Utah, put out a post that said they were going to increase tariffs and called into question whether or not they are even going to have this meeting in South Korea on November 1st, and basically just kind of jolted the market. When we thought that all of this was behind us, it's very much still alive and well. And the market ended up down about 2.5, almost 2.75% just on Friday. If we were to look at the contributing companies, it's the same top 10 that have been driving the market up. So almost 2/3 of the decline that we had just on Friday came from our top 10 companies that have been doing well and leading the market higher. So it was still a broad-based decline. If you're interested in seeing who contributed to the positive gains, it's going to be a lot of the consumer staple type companies, energy, utilities, things that people are still going to be spending money on, regardless of whether or not we end up in a recession because of this, and less on the technology semiconductor side. But yeah, so just a very interesting turn of events on Friday. Like the newsletter and video I was planning to do completely went out the window once Friday came through. But anyway, so interesting on the stock market side. As far as interest rates are concerned, again, this is our normal yield curve of U.S. Treasuries, bonds issued by the U.S. Treasury Department, interest rates over here on the left, maturity lengths on the bottom. Green line is where we are as of Friday, and the brown line is where we were 2 weeks ago. So we had been seeing a normalization of this yield curve where the short-term rates are supposed to be lower than the medium and longer term rates, so that you get compensated for investing for a longer period of time. That got put on pause on Friday, and so for the 2 week period, those short-term rates didn't really move. The medium and long-term rates shifted down a little bit. Which, again, over a 2 week period, this isn't necessarily a move that gives me too much concern. But if this all happened on Friday, then yeah, for a one day shift, that's pretty sizable. Okay, next, not sure exactly how relevant this is going to be anymore, because Friday inserted a lot of uncertainty into uh, what we're expecting going forward. But we saw some charts, some analysis by our friends at MRB Partners, trying to actually put some hard data to global growth. There were a lot of fears that the U.S. trade policy and the tariffs would cause global recession, slow things down for international and emerging market economies. But the data suggests that that has not happened. So we saw a large spike in global imports and exports from emerging market companies in the post-COVID world. We did see a dip as inflation and interest rates rose and kind of put a curb on imports and exports and through 2022, but seen an increase over the past few years. And this little decline here in the beginning of 25 is the tariff policy that slowed things down briefly, but it looks like the trajectory to me has actually increased since April. So that is something that we are watching. We did a rebalance a few months ago, ended a rebalance a few months ago where we were shifting some of the investments in US companies out into international and emerging market companies, which have done better than the US counterparts so far this year. We also met with our portfolio analytics team at Fidelity, and they said that we actually had done that ahead of our peers. So we were congratulated for our foresight into making those adjustments before other financial advisors and institutions that they work with as well. So um, patting ourselves on the back, I guess, for that. Something that we're looking at for our next rebalance, or something that we're potentially concerned about, and just kind of wondering at what point we want to make this move. But generally speaking, at Diamondback Financial, we like equal weighted investments, equal weighted indices versus a market cap weighted index. So, yeah, for example, the S&P 500 is a market cap weighted index. We've already pointed out that there are 10 companies that control about 40% of what the market does, right? And while we've been invested in a market cap weighted index, and we've seen the benefits of investing in those over the last couple of years, there comes a point where shifting from the market cap weighted into an equal weight index allows us to avoid some of that volatility from those top 10 companies. Equal weighting now has equal investments across all 500 companies, as opposed to 8% in Nvidia and 6% in Amazon and Apple and those other companies. So instead of putting so much of our eggs in those baskets of 10 companies, we're trying to spread it out evenly among all 500. So it doesn't have to be that we see a significant decline in those top 10 companies. They could be relatively flat or just maybe single digit returns. But if the other 490 companies do well, then that equal weighted index should outperform the market cap weighted. So it doesn't happen often throughout history. The market cap weighting tends to still be the dominating index. But if we look at something like the dot-com bubble over here in chart 12, we've got the NASDAQ, which is a market cap weighted index, mostly technology stocks, and the S&P 500 all also listed here. But the equal weighted S&P 500 listed here on the bottom. So we saw in March of 2000, both the NASDAQ and the S&P 500 hit a peak. By August of 2000, the S&P 500 had recovered pretty much to where it was in March, but the NASDAQ never did. And then we saw the dot-com bubble burst. NASDAQ dropped, I think, about 80% from the highest peak to the lowest point, and the S&P 500, I think, was down about 50%. Equal weighted index did not have the same experience, right? They peaked a year later and didn't decline as much as the overall market, and was able to recover faster than the market cap weighted. So, again, we're not necessarily expecting a similar experience now. There have been some economists and professional investors who are making comparisons of 2025 to 2000. We don't think that is the case personally, but it could allow us to shift some of our market cap into the equal weighted to try to reduce the volatility that we would see should something like this happen. But we believe we tend to see a peak followed by another peak, which would give us an opportunity to then do that rebalance. So we don't think we missed the boat on Friday. We don't think that this is the start of a major bubble bursting. We would expect that over the next 3 weeks, President Trump and President Xi in China will still have that meeting, and maybe there's a little bit more back and forth between now and then. President Trump's still making sure that he's keeping himself busy with the government shutdown and with trade negotiations and whatever purpose he feels like he's achieving with all of this. But yeah, so this is kind of what we're thinking of the next rebalance, but we'll keep you posted when we're finally making that shift. But we are still kind of feeling like we don't want to make any other drastic changes. We think whatever this was on Friday will play out, and we're gonna hold firm until we see something suggesting we need to make the change. As a final word, my oldest son is prepping to be in a high school play based on the game Clue. I think they also made a movie about it. It seems like all of these murder mysteries are kind of the same. Everybody gets together, the lights go off, somebody screams, somebody dies, the lights come back on, they see the dead person, and then they have to decide who done it, right? We didn't really get into the whole government shutdown that has been going on ever since the end of September. But during this period of time, we're not getting the official government collected economic data that we tend to rely on to understand where we are in the business cycle and economic cycles. And kind of feels like the lights have turned off. And there are people who are screaming. And at some point, the lights will come back on, and we'll have to assess the carnage at some point. President Trump has ordered for the inflation report to still come out before the next Federal Reserve meeting. So we'll get that in a couple weeks. But yeah, by and large, we're not getting anything else. This has happened before, but it feels like it came at a sensitive time. And so we're hopeful that there's not a lot that we have to worry about when the lights come back on. But it just, it felt like things were going relatively well. October may end up being a little bit more of a volatile month. So the next few weeks will be interesting. And we're grateful that we're able to come in and sit in this chair and keep our ear to the ground so that we can figure out what's actually something that is actionable that we need to take seriously, and what's just noise that we can disregard. And so we're grateful for you. If you have questions, concerns, let us know. Otherwise, we'll be in touch and we'll keep working hard. Have a good one.